Hello, good morning. I am Avnish Jain. Welcome to the monthly debt outlook from Canara Robeco. Let's look at global happenings first. The world remains uncertain post Trump administration taking charge of the US economy. Their policies, especially on tariffs, immigration, and now the latest trying to end the Ukraine and Russia war have led to chaos in the world. The tariff situation is still unclear and the uncertainty hitting all markets. We have seen world global markets, especially equity markets, gyrate up and down as Trump announces different policies at different points of time. Currently, Trump is threatening to impose 25% tariff on Canada and Mexico and 20% tariffs on China imports. Overall, the environment remains uncertain and markets are not able to make a head of tail of what is happening, and hence the markets remain in a volatile but sideways movement. Overall, in the US, the economy has been moderating for some time and the GDP growth came at 2.3% against 2.8% last year. So clearly there the growth is slowing down. The US Fed paused in January after cutting rates by 100 basis points in the last quarter of 2024 due to inflation remaining sticky at about 3% and growth moderating only slowly. Also, the US Fed may be afraid of how Trump policies will work out in the future because higher tariffs on imports may lead to inflation in the longer run. The US Fed seems to be waiting for the storm to wind down before they start taking any action. However, with the growth slowdown, there is a possibility that US Fed may go again into action in the latter part of the year. Overall, debt markets benefited from all the chaos. The US 10-year, which hit 4.80 just before Trump was sworn in, has now fallen to about 4.23, fearing the worst that the global trade war may lead to a sharp slowdown, though inflation fears are still not come out very strongly. Coming to India, the main event in February was the union budget. The government stuck to the fiscal consolidation efforts which have been going on for last 3-4 years post-COVID. They were targeting 4.5% in FY26 as a fiscal deficit target when they started the FRBM process again. However, they overachieved that target, or they are set to overachieve that target by budgeting 4.4% for FY26. Also, they overachieved the budget target of 4.9% for FY25 by announcing that the expected fiscal deficit now for 4.7% for FY25. Overall, the government consolidation efforts are good, likely to be good for the debt markets, as lower borrowing from the government will lead to a lower interest rate scenario. The next major event was the RBI monetary policy under the new governor, Mr. Sanjeev Malhotra. He did not disappoint. RBI cut rates, the key policy rate, by 25 basis points, though they kept the stances neutral to retain the flexibility in the uncertain world where Trump administration is creating a bit of a chaos. Markets, however, did not receive that information well, and while market had rallied a bit before the policy, they gave up the gains and now are more range bound with 10-year around a range of 665 to 675. Overall, the policy was positive from a market perspective. However, RBI did a lot of things out of policy which were more positive for the market in terms of liquidity enhancing measures. Liquidity had become tight from October-November 2024 due to interventions by RBI in the forex markets to reduce volatility of the rupee in light of the dollar strength overseas. To that extent, RBI sucked out liquidity or has been sucking out liquidity for a number of months. This has led to a situation of a deficit of liquidity which was preventing banks from lending freely in the market. To that extent, the governor, Mr. Malhotra, had promised to inject again durable liquidity in the market via various methods. The methods chosen till now has been an open market operation purchase of government securities of almost 100,000 crores or 1 lakh crores, USD INR swap of almost $15 billion, that roughly is about 1.2 lakh crores. Also, they announced long-term variable repo rate auctions to the extent of about 75,000 crores. RBI is likely to continue with its efforts to inject liquidity via open market operations or USD INR swaps as required. March again is going to be a month of slightly tighter liquidity as advance tax outflows happen every March, and that generally impacts the liquidity in the market. From a macro perspective, inflation also has fallen finally. It has come down to 4.3% in January from 5.2% in December and a high of 6.5% seen last year. The correction was mainly from food prices as good winter crop has brought down prices sharply in the markets. This is positive news for RBI. They've already cut once. We do anticipate RBI to cut rates again in April by 25 basis points. There are more expectations of further rate cuts down the line as GDP growth has slowed somewhat. In third quarter of FY25, the growth came at 6.2%, which was as expected, and it has recovered sharply from a 5.6% revised growth for second quarter of FY25. However, it's still subpar, and RBI has to make the efforts to ensure there is sufficient liquidity in the markets for onward lending by banks. Next year's growth is also expected to be in the range of 6.3 to 6.8% as per government estimates. RBI itself is forecasting 6.7% growth, which is near the upper band of government's expectations for FY26. Overall, the rate scenario remains positive. Markets have been fairly sideways after the policy, and the global uncertainty is not helping markets to move in either direction. While we do not anticipate any sharp upward movement in yield, the markets may drift lower slowly only over the next couple of months as uncertainty winds itself down and there is some more clarity on the Trump administration's tariff plan, which are currently up in the clouds, and there is no certainty on what might happen in the coming months. The Trump administration also set the date of April 4 when they are going to put tariffs across the world. So we have to wait for that time and how things move forward from there. So next couple of months are going to be volatile, but we do see a downward shift in the yield curve based on one, rate cut expectations in April and beyond. Second, RBI liquidity enhancing measures in the coming months. In the interim, we expect 10-year to move between 665 to 675 range only. Probably you may see some market rally before the policy which is scheduled in April. For the investors, we anticipate that the front end of the curve is still quite rich. And for short-term investments from 3 to 6 months, investors may choose to invest in low-duration funds or ultra-short-term funds. For long-term funds, there is still some rally left. We expect the yield curve to drift lower over the next 12 to 18 months. One, because growth is slowing down a bit and RBI will do its own bit to bring rates down over the next 6 to 12 months. US economy is slowing down a bit and all these trade wars will likely lead to slowdown across the world. Third, while inflation may remain sticky overseas, our inflation has been responding well to RBI policies and government efforts. Overall, we should see the rate curve drifting down over the next 6 to 12 months. And this gives opportunity for long-term investors to look at duration funds like gilt fund, dynamic bond fund and income fund. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.